Unit 4. Economic categories. This chapter is designed to introduce concepts of economic categories, their classification and basic features which FDI advisors should be familiarized with. With this knowledge you will become proficient in basic concepts of economic categories. Good identifiers of the characteristics of economic categories and their basic classification. Accounting categories and terms are defined by accounting standards. These are the principles and rules of recognition, measurement and classification of business events and the preparation and presentation of financial statements. Accounting standards are not static. They are being continuously complemented and changed, parallel to the development of accounting theory and practice. Slovenia is applying domestic and international financial reporting standards as accounting standards which are subject to the Accounting Act. Slovenian accounting standards are established and interpreted by the Slovenian Institute of Auditors, which is authorized by the state for regulating and supervising the accounting profession in the Republic of Slovenia. Let's start with the balance sheet, which illustrates the assets, those elements of the company without which business cannot be organized at all and which are divided into long-term and short-term, and liabilities to their sources, capital and liabilities. Income statement is a financial statement which shows the results of operating activities in a certain time period. The usual period is a year. It shows incomes and expenses. The difference between incomes and expenses is the result of operations during the period considered, profit or loss. A asset. An asset is a resource or property having a monetary economic value, owned by an individual or entity, which is capable of producing some future economic benefit. Assets are generally brought in business to benefit from them and to increase the value of a business. An asset may be used individually or in combination with other assets in the production of goods or services that an entrepreneur will sell, exchanged for another asset, used to settle obligations or divided among the owners. Assets are reported on a company's balance sheet, and they are bought or created to increase the value of a firm or benefit the firm's operations. An asset can be thought of as something that can generate cash flow in the future, reduce expenses, improve sales, regardless of whether it is a company's manufacturing equipment or a patent for a particular technology. One of the classifications of assets is based on their physical existence. According to this classification, an asset is either a tangible asset, intangible asset or money. According to classification of the assets based on their function and lifetime, there are two types of assets. Long-term assets, or fixed assets. Current assets, or short-term assets. Long-term assets are those that are usually restructured over a period longer than 1 year. They consist of intangible assets, patents, licenses, computer programs. Tangible fixed assets, land, buildings, equipment. Investment property, that is real estate used for the purpose of renting since the beginning of the acquisition. Long-term financial investments, loans granted, securities investments. Long-term operating receivables. Long-term deferred costs and accrued revenues, development costs, investments in foreign tangible fixed assets, investments in real estate rented out. Current assets are those that are usually transformed over a period of time shorter than 1 year. They consist of assets for sale, stocks, material, packaging, merchandise, finished products. Short-term operating receivables, to customers, receivables for input VAT. Short-term financial investments, loans granted. Cash funds, cash on a bank account, cash stock. Short-term deferred costs, example, insurance paid once a year, at the expense of the monthly premium. Since we pay the entire premium in advance and it does not represent the cost of the month in which we paid it. Fixed, long-term, financial assets are shares in affiliated enterprises, loans given to affiliated enterprises, interests, investments in bonds, loans, deposits, personal shares etc. Current, short-term, assets are expected to be converted into cash in a very short time, usually within 1 year. Commonly, they include money, investments in active securities and supplies. Current assets appear in all three basic forms: goods, rights and money. The balance sheet of the current, short-term, assets includes supplies, short-term receivables, from customers, affiliated companies, employees, government, short-term financial assets, received short-term securities, checks, bills, short-term given loans, given deposits, shares in affiliated companies, etc. Cash and cash equivalents, money in banks and in cash registers, foreign currency payments, etc. Actual time delays, prepaid costs for the future periods and undue revenue collection. B. Liability. Liability is a company's financial debt or obligations that arise during the course of its business operations. Recorded on the right side of the balance sheet, liabilities include loans, mortgages, obligations towards suppliers, deferred revenues, etc. According to the International Accounting Standards, liability is defined as the current obligation of a company resulting from past events. The settlement of those liabilities would result in the outflow of resources containing economic benefits. Liability is the duty or the responsibility to act or do something in a certain way. Liabilities can be legally enforceable and can be derived from business practices. Payoff of the current liability can be accomplished in several ways: by cash payment, by transferring another asset, by providing services, by replacing one liability with another, or by creditor losing his rights or waiving them. According to the payment deadline, there are two types of liabilities. Short-term liabilities are expected to be settled within 1 year, counting from the balance sheet date. Short-term liabilities include liabilities for received loans, deposits from citizens or other companies from the country of origin or abroad with a payment deadline of less than a year. Long-term liabilities are usually incurred for the purpose of acquiring long-term assets or refinancing long-term assets that have not matured. Each asset has its own source. Liabilities are composed of capital. Own capital is considered to be the capital that is expressed as an obligation to the owners and divided into the called-up capital invested by the owners when it is incorporated into the company. Capital reserves, reserves from profit, retained earnings, revaluation surplus and net profit or loss. Debts, foreign equity represented by provisions and accrued costs and deferred revenue, long-term financial liabilities, long-term operating liabilities, short-term financial liabilities, short-term operating liabilities and short-term accrued costs and deferred revenue. C. Capital. When establishing, owners of an asset may invest in the company as part of a capital contribution, but they may immediately sell the asset to an entity, thereby showing liabilities to sources or owners. Liabilities indicate where the funds come from, or who owns them. A permanent source of funds means an obligation to the owners which is disclosed as equity. Thus, we can talk about capital adequately when a company has at least those fixed assets which are covered by its own resources, using equity capital. This information is very important in the negotiation of a loan. Capital refers to financial assets or the financial value of assets which are left to the owners after all liabilities are settled. In the case of a joint stock company, the capital is expressed as a share capital, and when it comes to a limited liability company, it is expressed as a registered basic capital. The balance sheet is breaking down liability into registered capital, capital reserves, reserves, revaluation reserves, retained earnings, profit or loss brought forward, earnings or loss for the current year. Capital can be invested in several forms. Money, by paying to the bank account of a company. Things, by placing a plant, equipment, supplies, etc. into a company. Rights, by entering a patent, license or some other right into a company. Regardless of whether it is a joint stock company or a limited liability company, the capital includes equity capital brought directly to the company by owners. Earned capital. The earned capital is the result of business activities of the entrepreneurs. It represents the difference between income and expense after taxation, that is after payment of capital gains tax. Based on the decision of the company's management, instead of being paid to the owners, the earned capital can be transferred to retained earnings. There are several ways to increase your own capital: by bringing the new basic capital to the company, by new members joining the company. By recapitalization, that is by increasing the basic capital by the existing members of the company. In the case of joint stock companies, DD, with public offering and capital gains. Capital reduction occurs in the following cases: current year losses, payment of gains for the current year or retained earnings of previous years to the owners, that is the payment of dividends to shareholders in the case of the joint stock companies. Repayment of the stake from the basic capital to the investor who exits the company. Impairments from revaluation reserves of reduced value of already revalued long-term assets. D. Income. Income is the gross of cash flow, claims or other benefits arising from the regular activities of a company from the sale of goods, provision of services and from the use of resources of other companies that make interest on royalties and dividends. Income is measured by claims from buyers and customers for delivered goods and services performed, and by fees and merits resulting from the use of buyers and customers' resources. Amounts charged on behalf of third parties, such as certain taxes, are excluded. In a representative relationship, the income is the amount of commission, rather than the gross cash flow, claims or other fees. Income recognition mainly refers to the situation when the income is recognized in the company's profit statement. The amount of the income deriving from a transaction is usually determined on the basis of an agreement between the parties involved in the transaction. When there are uncertainties regarding the determination of the amount or the related costs, these uncertainties could affect the determination of the time of the income recognition. Income recognition requires that the income can be measured and that its final collection can be expected at the time of sale or provision of services. The real expectation of the final income collection ensures that payment by itself. Where there is not possible to estimate the payment with certainty at the time of sale or provision of services, the income recognition is delayed. In such cases it is appropriate to recognize the income only when money is received. If there is no uncertainty when it comes to the final collection, the income is recognized at the time of the sale even when cash payments are made in installments. Incomes in the balance sheet represents assets, which means money or receivables for sold goods that have not yet been paid by customers, or in case of reduced liability, which means that we have reduced our debts. We divide them into business, financial and other revenues. Business income is obtained during the regular company's business, that is by selling finished goods, by providing services, renting land, business premises, etc. Business income is revenue from sales or other income related to the sale of business effects. The disclosure of operating revenues on the other hand results in a reduction in inventories of goods, which further implies operating expenses. In short, we can say that operating income is the result of a product of the quantity of goods sold at a given price. Financial income is obtained through positive exchange rate differences and interest rates for lending financial resources to a legal or natural person. Financial revenues arise as a result of investing, such as investments in loans, shares or shares of a company. Other revenues are those that cannot be classified in the above two categories. These can be subsidies, grants, damages, income of penalties and a few others that are not directly related to business effects. Expenses. Expenses are decreases in economic benefit during the accounting period in the form of a decrease in asset or an increase in liability that result in decrease in equity, other than distribution to owners. Recognition and measurement of expenditures depends on the concept of capital and its preservation used by an entrepreneur when compiling and presenting financial statements. Expenses are recognized in the income statement when the reduction of future economic benefits results from a decrease in assets or an increase in liabilities and can be reliably measured. This means that the recognition of expenses occurs at the same time as the recognition of an increase in liabilities or decrease in assets. The main types of expenses are business, financial and other expenses. Business expenses are the result of the company's core business and their scope depends on the volume and type of business. This includes the costs of production incurred due to the effects, the purchase of merchandise goods, administrative expenses and other expenditures needed for basic business processes, purchase and sale expenses, if specifically accounted for, and subsequent adjustments to costs that are accounted for as operating expenses. Operating expenses are those that are recognized when the costs are no longer retained in inventories or when they are sold. They can also occur independently of sales, that is, they include those costs that are not included in inventories, but are direct costs. Financial expenses are the result of obtaining, using and reimbursing financial resources. Financial expenses include negative interest rates, negative exchange rate differences, a decrease in the value of long-term and short-term financial investments and the coverage of the negative balance of revaluation reserves. Financial expenses are expenses for financing and investments. We can divide them into operation that is related to the creation of business effects and operation which is intended solely to generate financial revenues. Other expenses, or sometimes extraordinary expenses, are all other costs that reduce the profit or loss and cannot be classified in the other two categories. These are expenses from depreciation of investment property, expense due to impairment of investment property, fines, damages, etc. Expenses or expenses that are deducted from the tax must be considered for costs and expenses. In this respect, an accounting officer must be consulted in advance, in particular for large amounts. The rule is that only those costs or expenses that are solely related to a company's operations or the creation of an advantage for the company are recognized. As an example, it can be stated that the tax deduction costs are travel costs of an entrepreneur or an employee who can accurately prove the benefits and future income of the company. The principle of matching revenue costs is always the same, since we cannot only have costs without revenue. This may take a short time, for example at the time of establishing a new company, while later the company must use what is reflected in revenue and, of course, in the positive result at the end of the year, from which we add something to the state budget. F. Business result. Business result represents the success of an enterprise expressed by monetary scales. Comparison between income and expenses reveals the financial result. When the income is higher than the expenses, the financial result is positive, gain. Loss represents a negative financial result when the expenses are higher than the income. According to accounting regulations, a company establishes a net gain in the amount of the difference between the established profit and the profit tax. In the case that the established profit before tax is not sufficient for taxes and contributions, a net loss is established in the amount of difference between the amount of tax and the established profit. If before taxation a loss is recognized, before the taxation the amount of loss is increased for the amount of profit tax, and a net loss is established. After determining the business results and based on a written decision of the owner or management, the profit is distributed, and the loss compensated. In the case of a loss in business, the loss is met from reserves, retained earnings from previous years, etc., in order to enable further business operations. When it is not possible to cover the loss, a bankruptcy proceeding is initiated, followed by the liquidation of the company. If, while determining the business results, it is clear that the company has been profitable, the profit is distributed according to the interests, priorities and plans of the owner. It is also important to differentiate between revenue and inflows as well as between expenditure and outflows. Revenues and expenses are dealt with in cash flows, while inflows and outflows are part of cash flows. We know companies that have profits, but money is nowhere to be found. The value of an issued tax-free invoice represents the income which will not be used as the inflow of money until the invoice is paid. On the other hand, a received invoice represents an expense, but the outflow of money will only start when the invoice is settled. For example, depreciation is an expense that is not an outflow of money, which means that it affects the operating result rather than the cash flow. When we settle the annuity of a loan, this is an outflow of money, which is not an expense and does not affect the business results. You should briefly summarize what the company must do at the end of the year. Before making a balance sheet, it is good to make an inventory to reconcile funds, and then determine the profit or loss as the difference between revenue and expenditure. We also have a cash flow statement that is not mandatory for small businesses and a statement of changes in equity, which is also not mandatory. Simple formula of profit or loss: all revenues are deducted from all expenses. If the revenue is greater than the expenses, the company's balance sheet shows gross profit at the end of the year, but if there are more expenses, it shows operating loss. At the end of an accounting period or a business year, the company prepares an annual report which must be a credible display of the results of all events that occur during the year. The company must also make an inventory of assets once a year and reconcile the situation with business books. In the event of a loss, the entity must first take care of its eventual coverage from previous statutory or other reserves, or from retained earnings for previous years, and from capital reserves. If this is not possible, the company will transfer the loss to the following year and arrange to cover it in subsequent periods of operation. In the case of a positive profit, the company must first calculate the tax on profit and any deferred tax assets and thus redistribute the net profit to the settlement of the loss, if there was any in previous years, and to the legal reserves, the purchase of own shares, the share of the shareholder in the net profit, and thus, only the residue can be transferred to the following year as unallocated profits. To read and understand the financial statements, plans, projects, etc., it is necessary to understand the concepts of economic categories and to be able to identify their features.